In this video, I want to talk about 20 costly stock investing mistakes to avoid at all cost. 20 costly stock investing mistakes you should avoid at all cost. Avoiding common pitfalls can greatly improve your stock investing outcome. So here are 20 investing mistakes to avoid as a beginner investor, as an experienced investor, whichever class you find yourself. These mistakes, if you can do well to avoid them, it will greatly impact the kind of returns you would obtain at the end of the day. Number one is lack of clear-cut investment plan, lack of clearly defined investment plan. Investing without a defined strategy, goal or risk tolerance can lead to inconsistent and poor decisions. Your objectives have to be very clear. Your goals need to be well defined. Your aim should be very, very clear to you, or else you may end up making decisions that are not in line with the kind of result that can yield the kind of result you want to obtain. And so let your objective be well defined, be clearly stated. That will serve as a guide to you and will equally influence your choice of strategies eventually. Number two is neglecting research. Neglecting research. Failing to thoroughly research a company, an industry or market can affect you seriously. You see, and before you invest, you must carry out in-depth research, so as to be well informed as it regards the kind of choice you make. Don't just wake up one morning and decide to invest in the stock because the stock is popular, because it is hyped, because of maybe FOMO, fear of missing out, whatsoever. Take your time, research the company, look into its financial statements, the balance sheet, the income statement, as well as the cash flow statements. So you research these parameters, these factors before you invest in any given stock. Number three is overconfidence. Overconfidence. Confidence is good. You can't invest, in a stock without sufficient confidence, but overconfidence is negative. It's not, and it should not be encouraged at all. So believing too strongly in one's ability to predict the markets or pick winning stocks can result in excessive risk taking. So don't be overconfident. I want to share a story with us here of a horse, a single horse race. There was a kind of horse race with a single horse. You expect this horse to win, being the only participant in the race. Well, people betted on the stock, on the horse, and the horse took off. Eventually, instead of getting to the finishing point, the horse jumped over the fence. So no matter how it is, don't be overconfident, because the outcome, cannot be 100% predetermined. Number 4, ignoring diversification. Ignoring diversification. So putting all your money into a few stocks or a single sector increases risk and leads to significant losses. Don't buy a few stocks, or don't just concentrate your stocks in a single industry, on a few industry. It will then increase your risks tremendously. Imagine putting your entire investment in the airline industry or in the airline sector during the pandemic. You end up losing almost everything because the airlines were grounded, as well as many other sectors like that. But assuming you were kind of diversified, you have some in the airlines, some in other industries, and even some in in online retailers like Amazon, Walmart, you could still make profit because you are highly diverse, you are reasonably diversified. Number 5 is chasing hot stocks. Chasing hot stocks, that is buying stocks based on hype or recent performance without understanding their fundamentals can lead to buying overvalued stocks. Before you buy a stock, make sure you understand the company's fundamentals. Don't just buy because everybody is buying. All right, the markets or the crowd may be wrong sometimes. So don't follow the crowd. Just make your personal investigation, your personal research. Look into the company fundamentals before you buy. Don't just chase any glamorous stocks whatsoever. Don't do that. Number 6 is market timing. Trying to perfect or trying to predict market highs and lows often result in missed opportunities and poor timing of trade. You don't time the market, all right? You don't do it because nobody can effectively or efficiently time the market or predict stock prices, predict when a stock will stop climbing and when a stock would rise up from the bottom. Nobody can effectively do that. Just buy your shares based on what the fundamentals says you should do. Don't just buy. Don't try to time the top or the bottom of stock price movement. It cannot be adequately or reasonably predicted. Number 7 is panic selling. Selling stocks during market downturn out of fear can lock in losses and miss out on potential, recovery gains. The matter is that whenever there is a kind of panic selling, means people, investors are selling their stocks en masse, out of fear, out of panic. Don't do that. Ask yourself, is the company fundamentals still intact? If the answer is yes, hold on to your investment. As it goes down, as the stock price plummets, if you have money, increase your holding, buy the move, because eventually the stock will certainly recover as long as the fundamentals, are intact. Not only that, number 8 is buying on the margin. Buying on margin. Using borrowed money to invest increases risk and can lead to large losses if the market moves against you. When you borrow money to invest, well, that could be a smart move. If you know what you're doing and the market, increases, you could equally make, an out of proportion, profit. But if the stock plummets, if the market goes against you, then that will magnify your losses because of the amount of money you borrowed on margin. Whenever margin calls comes in, you'll be forced to sell your stock at a loss so as to be able to meet up with your obligation to your stockbroker or to the bank that lends you the money in the first instance. Number 9 is neglecting rebalancing. Failing to periodically rebalance your portfolio can lead to an unintended risk profile or missed growth opportunities. When you buy stock, don't just go to sleep, don't just go to rest. You watch your investment individually, watch the condition of each stocks, watch to determine whether you should sell or not to sell, whether I should add to a particular holding or not to add. Make sure that you rebalance your portfolio as the risk arises, as the need arises. That will help you to be able to, obtain optimal return at the end of it. Or not only that, focusing too much on short-term gains. Focusing too much on short-term gains. Well, gains actually, gains remains gains, but don't focus on short-term profits. Prioritizing short-term profits over long-term growth can lead to unnecessary trading and increased fees because you want to realize short-term gains. Number one, it's going to attract a high level of capital gain tax, and not only that, you may miss out of the level of accumulation of growth, or profits or returns over the long run. So don't focus too much on short-term gains. Focus on the long run. Sometimes you may rush to sell a stock because the stock had increased by 10 or 20 or 15%. You rush and sell, not knowing that this particular stock is about to even double. It's about to obtain 100%, increase in price. So because you rush to sell, because you're focusing on short-term gain, you may miss out of the, of a better opportunity, in that stock in the near future. Number 11, not understanding what you are investing in, not understanding what you are investing in. It happens sometimes, actually. Investing in complex products or companies without understanding their business models, risk or financials can lead to unexpected losses. You don't just buy a stock because the name looks kind of glamorous, or the name looks attractive, or the stock is popular. No, don't do that. Make sure that you fully understand what you are doing, and don't invest in complex companies you don't really understand their business models. No, basically understand how does the company makes profit, what is its inherent or coherent or core business and model. All these things will help you to be able to have the confidence to stay put when the market tends to go against you. And so before you buy stocks, make sure that you understand what the company is all about. Don't just purchase ignorantly. It's not encouraged at all. Number 12, following the crowd. Following the crowd. The crowd is not always right. When it comes to investing, sometimes it might be a lonely journey. You may be the only person on the path, but make sure that in your loneliness, you know what you are doing. Because sometimes the crowd can be right. Sometimes the crowd is never always right. Okay. And so making investment decisions based on what everyone else is doing without your own analysis can result in poor outcomes. Don't follow the crowd. Avoid all this harsh mentality. Sit down very well. Sit down, carefully, and make sure you analyze the stocks you want to buy, and then you buy at the right time, at the right price, regardless of what the entire market is doing. Be a contrarian investor. I spoke about contrarian investing in one of my videos. You may look it out. You may watch out for it in the channel. Number 13 is ignoring fees and commissions. Ignoring fees and commissions. And so not considering the impact of transaction fees, management fees, and other costs can eat into your returns. One funny thing is that these fees, generally are very, very, they are sort of minute or negligible. Sometimes, most of the times, they are just single digits, level of fees here and there. By the time you add up these fees over a period of 5 to 10 years, you will know precisely how much you've lost just on fees alone and commission alone. So don't ignore this, little fees here and there. Make sure that as much as possible you try to avoid them wherever possible. And not only that, number 14, falling for get rich quick schemes. Falling to get rich quick scheme. You might get scammed because you want to be rich overnight. Believing in unrealistic promises of quick and large returns can lead to scams or high-risk investments. Don't fall for all those, someone telling you invest today and by tomorrow you're going to double your money, all those kind of schemes. Be very, very careful. Sometimes, or most of the times, they don't turn out to be real. They don't turn out to be true. So avoid those things, because generally when it comes to wealth creation, outsized wealth creation, takes time. It's not done in a hurry, and it doesn't really happen overnight. So take your time, invest, with a long-term horizon in mind. People like someone like Warren Buffett, the richest investor in the world now, have been investing for over 50 years, over 60 years, even over 70 years. You can look at the time horizon. You'll never be in a hurry. The stock market is not the place for those who want to make it very, very fast. You can try other investments, but not the stock market. Number 15, neglecting tax implications. Neglecting tax implications. So not accounting for taxes and capital gains, dividends, or other investment income can reduce your net returns. when it comes to taxes, you have to take into consideration capital gain tax. As much as possible, hold your investment for a longer period of time before you sell. Because if you sell within a short period of time, it will incur a higher level of tax. So if you sell, over a long period of time, after a long period of time, that will incur a lower or a lesser level of tax. So don't neglect the impact of tax on your portfolio. Number 16, holding on to losses for too long. Holding on to losses for too long. The matter is that, refusing to sell underperforming stocks due to emotional attachment or hope of recovery can lead to larger losses. Whenever a company sustains losses, ask yourself, this particular loss the company had sustained, is it temporary? Will it occur in the future? If it's a temporary kind of condition, well, you may hold on to the stock and even buy more, because the stock will certainly increase in price when performance of the share of the company improves. But if the company is inherently sustaining losses, don't get emotionally attached to a company. Please cut and run, cut your losses and then take your leave. Invest some money elsewhere. There are thousands of companies in the market, as the case may be. So don't get emotionally attached to a loss-making company. It's not advisable at all. Number 17, selling winners too early. Selling winners too early. Well, it's easier to buy stocks, very easy to buy. But when to sell could be problematic. Okay? It could be problematic. And so refusing to sell, so taking profits too soon on stocks that have potentials for further growth can limit your overall returns. Let's say, for instance, you bought a stock at, let's say, $10, and that stock is bound to go to as much as $60 or $70 or $80, or even $100, and you sold that stock at $20. Imagine what you've lost. Imagine the gains that awaits you, assuming you did not sell the stock too early. So don't sell the stock. When you buy a stock, consider an exit strategy. So, well, these stocks I'm buying, I will not sell as long as the company is doing well. You hold on to your stocks. That's how you will be able to accumulate gains, over time. But you just enter without an exit strategy. When the stocks, you bought at $10 and you go to $20, you sell off. No, it's not a good strategy at all. Number 18, ignoring the power of compounding. Ignoring the power of compounding. Albert Einstein said that compound interest is the eighth wonders of the world. And so don't ever ignore the power of compounding. Failing to reinvest dividends or not holding onto investment long enough to benefit from compounding can reduce your long-term gains. When it comes to enhanced performance, outsized performance, above average performance in the market, generally you allow the principle of compounding to take effects in the market or in your stock or your portfolio. Keep on holding your stocks. As long as the stock is doing very well, it's doing fine. Hold it for 3 years, hold it for 5 years, for 7 years, for 10 years, for 15 years, as the case may be. Just keep on holding. So this compound effect at the end of the day is what is going to give you an outsized returns. Don't rush to sell. Make sure that you harness this particular power of compounding. It will do you, a ton of good. It will really impacts, your returns in a way that is almost like unimaginable. All right. And so number 19, overtrading. Excessive buying and selling increase, transaction cost and may lead to suboptimal investment performance. Usually this is what your broker will never tell you. Your broker will not tell you to minimize transaction costs. They will never tell you to to trade less, because the more you trade, the more they make their money, the more commission they extract from you. Okay, so don't over trade. As long as you're not a day trader, hold your stocks for a reasonable length of time, because the more you trade, the more you incur fees. You know, each time you buy, you incur fee. Each time you sell, you equally incur fees. I had an investment in a particular stock. I just kept the stock as if I'm not even, as if I'm not even existing. So my broker called me and said, what was happening? You've not really you've not been active these days. I said, well, I don't need to be active. Let my stock remain there and compound. Because if you don't buy and you don't sell, they don't make money. Now they will call you and ask you to, why don't you buy this? Why don't you sell this? That kind of a thing. So as long as your stock is doing very well, keep it. Allow it to remain and compound and avoid over trading. Then lastly, number 20, lack of patience. Lack of patience. So expecting quick result from stock investment can lead to disappointment and poor decision making. Investing is a long-term game, and patience is key to success. I know of a legendary investor, and I was told this individual held a particular stock for about 40 years. you know, he held the stock of, I think, Motorola or so for 40 good years. That's what they're talking about. Patience. All right. And so by avoiding these mistakes, investors can enhance their chances of achieving solid long-term returns in the stock market. So simply avoid all these mistakes and you are good to go.